We are we are live, we're on YouTube. Welcome to our monthly podcast. This month we are focusing on reverse mortgages. And you may be out there thinking, what's a reverse mortgage? What's a forward mortgage? What are these terms? Well,
Distinction.
believe it or not, a forward mortgage is what most of you probably have. When you get a loan and you're making payments every month, that's called a forward mortgage, a 30-year fixed, FHA, VA, whatever the mortgage is, that's considered a forward mortgage. And you make payments monthly. So what's this reverse mortgage? Well, it's still a mortgage. There's still a mortgage on the home, but you don't have to make payments out of pocket. Instead, the equity in the home is, in essence, making payments because the balance goes up on a monthly basis. So you don't pay out of pocket. The mortgage balance increases every month. So you may be saying, why would I want a mortgage like this? Well, a lot of people like it because they don't have to make their cash flow. Their cash flow is better. They don't have to make any payments out of pocket. And then they just let the equity in the home continue to be used to pay the mortgage. Now, you still may have to pay, you usually have to pay your own insurance and taxes. There are some
Yes.
exceptions.
Yeah.
We may not get into those today because it can be a little, but anyway, that's kind of just a very glossy overview of what a reverse mortgage is. And today, as I mentioned, we're going to be doing a deep dive into reverse mortgages because we're lucky enough to have a specialist in our midst who's a part of our group, Clay Selland. He's a certified reverse mortgage professional. He has his own mortgage company called Signet Mortgage in California, but in Arizona, he's partnered up with us here at Counsel Mortgage. And then we also have Kirk Shaw here, who is certified in real estate probate, and he may jump in with a few items as we go along. But Clay, with that, why don't you go ahead and take it away?
Okay. Let's do. Oh, there we go. Sorry, wrong button. Anyhow, so this is me, just a little bit of an introduction, and that shows up now. Just fine.
Yep, yep.
Yeah, okay, cool. Um, the these are two statements that I think are a good start because we're not talking about the desperate homeowner losing a house, all that sort of stuff, which is the perception, and quite frankly, some of the advertising related to reverse mortgages. So even the most well-prepared homeowner could improve the confidence in their retirement by considering it's a home equity conversion mortgage. That's the government's description of a reverse mortgage, but we call it either a retirement mortgage or reverse mortgage. And every client buying their retirement home should know how home equity conversion mortgage can be used to improve their retirement outcome. That's what we're trying to do. And so I have to find this thing. I have to find the thing that tells me, oh, stop sharing. Okay. So um, I got to make sure this happens. So, so this really isn't about solving a problem. It's about improving an already solid retirement plan. That's where the satisfaction I get and the joy I get in helping people. It's taking them from where they are to where they want to be. So, and quite often don't think they can. So it's turning their home equity and turning it into flexible, confident, and choice in retirement. And John mentioned, we're using equity. You partially using equity, but it'll be important to note we're using appreciation too, because we're fortunate in the West to expect some appreciation. And so, yeah, we're giving something away, but look at the benefit we're getting a home and without a required mortgage payment. And you do have to pay taxes and insurance. That's kind of one of the rules. Don't get away from that. So, um, and most homeowners have never actually seen how this works with real numbers. And usually, once we see real numbers, you say it's the aha moment kind of stuff. So I'm trying to get a mindset shift. Doing nothing with home equity is a decision, and it often leads people to simply accept where they are, and I'm going to pass the home on to the kids, and that's the way it's going to be, instead of taking control and using it in a way that could be of benefit. Using it as a strategic asset in retirement, right along, it's the same level of importance as your investment portfolio, your IRAs and retirement accounts, and your overall income strategy, how you're going to live out a retirement. And again, it's not a need, it's a strategic option for those that are fortunate to have a home and have made the decision years ago to buy a home and all that sort of stuff and develop real estate equity. Those are the ones that we want to talk to. So there's three audiences really, and this we're going to talk about all three, mostly seniors, but seniors and their families and advisors, because when we're talking about a reverse mortgage, you're always going to ask somebody else what they think. And if they're not up to speed, we'll be polite and say up to speed, um, they're not going to help. So we're looking for, this discussions designed for thoughtful, well-prepared homeowners. Those are great. And seniors who want more control and not more risk. There's only about 1 in 10 realtors who have really understood how a reverse mortgage can be incorporated. And that's sad because almost half the buyers in the last couple of years are over 60. Buyers and sellers are over 60. So we're active as seniors buying and selling. And many of those did so with half of those did it with a conventional mortgage. It's kind of like, well, why at 70 or 65 or 70 are you doing that? So we're going to try to change that mindset. And financial planners aren't a whole lot better because they have a reluctance and it's a lack of knowledge of how home equity can be incorporated in their toolbox. And so we're trying to change that. So confidence in retirement is not just about net worth, it's about access to that. A home equity is an illiquid asset, and we want to look at that as how can we make it liquid and gives you flexibility to do more. And we're always up against hesitation, fear and hesitation, and it's lack of knowledge probably as much as anything else. Most retirees aren't short on assets, they're just short on confidence. And so you even have assets and you say, well, I don't know what's happening. You don't have a buffer. You've got to get by with what you have. And if you don't consider home equity, then it's less of a buffer, right? So home equity becomes a reserve people didn't realize they already had. Um, and I qualify as a senior, so if anybody's offended at calling people seniors, I'm sorry, I'm one, so I had to be part of that. But and we're concerned about running out of money in retirement. You don't know when your checkout date is, and so you've got to manage your assets such that they'll last for an indefinite period of time. My grandmother passed away at 104 and a half. Okay, I got a ways to go, I think so. Anyhow, and shoot, you can just day to day is uncertainty. Things change. In the last month or so changes, and you got to just, it's a factor of your confidence in the future. So the perception starting, yeah, oh, perception starting out as reverse mortgages are bad. Everybody has that perception, just again, out of a lack of knowledge. The and a lack of idea of what's possible. And the reverse mortgage, I mentioned this earlier, is a terrible description. So let me tell you how we got here. Reverse mortgage originally was an insurance product, and that changed in the Reagan administration, realizing that we don't want an insurance company to benefit from an early demise of a borrower. So it was brought under FHA and HUD, and it's highly regulated, like to a fault. I like to call it or describe it as deferred payment loan. So yes, there is a payment. You don't have to make the payment on a monthly basis. You can, there's some strategies that make sense that way, but it's due when the home is no longer a primary residence. If you think of that, so that's either deciding to leave, leaving, passing away, whatever, we'll do it. So there's two big strategies, and both are very different, and both incorporate a reverse mortgage. The accessing home equity is a retirement tool, not a loan. So the best strategy is often to set it up and let it grow. So it becomes a real reserve, costs some money to get in it, but then you have a line of credit that grows at the interest rates and compounds. So gets to be significant numbers over time. as opposed to idle equity that just sits there and it's still locked up forever and it doesn't grow as fast as an unused credit line will. And you know, access to the funds, you could take lump sum out for whatever purpose. Like it's a line of credit or a combination or a monthly amount. There's a lot of ways to get it to match your retirement goals. And um, and I think of the one of the um, cool discussions I have with clients is they're waiting to retire. They're going to get their loan paid off, their existing mortgage paid off in 5 years, whatever. And it's $100,000 mortgage, but it's a $2,600 payment. And that's preventing them from either between health and or what they want to do from retiring. And you could say, well, hold on, if you do the reverse mortgage, you pay off that $100,000, give yourself a line of credit access, and you can retire today. And that's freedom, that's choice. And I never try to make a decision for people. I'm obviously not qualified to do that, but giving them choice is really a lot of fun. So generally requirements are generally only, and can't cover everything, but there are a couple of rules. Primary residence, that's it. It has to be your primary residence. It has to continue to be your primary residence. If there's two borrowers and one goes into assisted living, there's still a borrower in the house, that's fine. I mentioned you're responsible for paying taxes and insurance. You can't get away from that. And you're responsible for maintaining the home. So, uh, and it's also based on well, it would be based on the youngest borrower. So if there's two or more, but let's say two people in the home, it's the
Yeah.
loan is based
Hey,
on,
Clay,
yes, sir.
you're breaking up. I didn't get the last sentence there.
The qualifying is always based on the youngest borrower.
Okay.
So, and you want borrowers, if you ever hear about, oh, we'll take so and so off, and I didn't mention yet, but the amount that's available is based on the value of the home, obviously, and then an older borrower will get more than a younger borrower because they need a reserve since you're not making payments. The calculation is such through age 99. There's no health evaluation or anything. And so an older borrower, let's say 80, only has 19 years to go. A borrower 62 has a lot more. So the borrower will receive, an older borrower will receive more proceeds, right?
Yeah, higher loan amount. They get a
Correct.
higher
Higher
loan
loan
amount than
amount.
the younger.
Correct.
Yeah.
Correct. And so that's one. And we always don't ever let anybody talk you into taking somebody off title or don't have them on the loan because that person, if you don't include them as a borrower and something happens to the older one, it's not their house. And they have, that's a terrible strategy and it's probably one of those stories that ends up giving a black eye to a reverse mortgage if somebody, did that. Not a smart thing to do. But anyhow, and then we have another important one that you have to have a history of being current on property charges. So paying your taxes, your HOA, and all that sort of stuff, you have to be current on that. You can't. We want responsible people, or the rules require responsible people to get into a reverse mortgage.
Is there a something relating to the condition of the property too, Clay?
Yeah,
You
it's
have
an
to
FHA
upkeep
loan,
it?
so it has, and primarily the easiest way to say it, it has to be health and safety. No broken stair treads. The one that gets people is that we look for before we get an appraisal is peeling paint. They don't care if the color matches, but they don't want exposed wood because they want that house to last as long as you do. So people complain sometimes, and I think, well, wait a minute, you want the house to be in good condition and not be something that you have to put lots of dollars in because you didn't pay it, had a lot of deferred maintenance. So. And the last big thing is to satisfy financial assessment. So there is an assessment done say, okay, the house is this big, there's this many people, you have to have, and the proceeds from the reverse mortgage can be counted, and you have to have that available to you to live because we don't want anybody for sure getting this and then not, and then being in a stressed position after it. The idea is to make everybody better off, not to mess up, and put them in a, or not have them in a bad position afterwards. So I'm going to share this. It's a lot easier to talk about numbers, and so I'll share this thing again. I'll just do the whole screen because it's easier to find. This is an example of somebody 65 years old, okay, $1.1 million, not an uncommon thing, has a current mortgage. And this is the numbers, how they'll work helping that person do what they want to do. If the reverse mortgage is the initial balance, so 355, there's some costs involved. So there's this initial balance in home value. And part of what I want to illustrate here is this individual, and these are always, I could base these on exact people, but they're all close. This person could be in the house for 20 years and their equity stays the same or actually grows. Okay. So this is illustrating, and this is real numbers. I didn't, I picked this out of a batch of examples that I have. And the point is between the appreciation and the fact that your loan balance is smaller, growing at a higher rate, but your home value is larger, growing at a slower rate, that combination means that they can live there for 20 years and have the same equity. This comes up when people, and I'll deal with it in a minute, say, well, I want to leave equity to the kids. Well, everybody wants to do that, wants to be nice. I think generationally, when we say, well, what's a big number? And in this case, I'd say, is a big number $700,000? And it's, oh, yeah. I mean, I remember the numbers are in 10,000 and 20,000, that sort of thing. And when we can show that with a reverse mortgage, living 20 years without a mortgage payment, and your equity still grows and is 800 some odd thousand at that time, it's pretty cool. Then this one, same scenario, except in this case, it's a paid off home. So with a paid off home, now the value changes. The first one was no mortgage payment for whatever period of time. And this is amazing. The same math applies here, but when they start out, they had this a home worth $1.1 million. The line of credit, again, 65 years old, less the home value, less the reserve, gives them access to about $355,000. That line of credit, if left alone, draws on a line of credit would reduce this, and in 20 years, that line of credit is $1.5 million. Now, if we do the math, we go from 65 plus 20 years. By the time that person gets to 85, they'll have access, staying in their home, can't be taken away, that they have access to $1.5 million. This is the best use of the reverse mortgage. I mentioned that earlier, that I think solidifies a plan. Because at the time, at 85, the chances of needing in-home care, whatever, other needs is more likely, and it'll be there. And again, it's a guaranteed return. The value of the home could fall apart, or I don't want to say fall apart because you have to maintain it, but it could decrease in value, whatever. None of that has any impact. The only impact is you have the line of credit, and it grows at the interest rate plus the mortgage insurance, which is a 7.25.
Yeah, this is a great example, Clay. So what you can see here is if your initial loan balance is 32,000, you still have up to 355. You qualify up to 350. You haven't drawn on it. You have 355 available that you can borrow against. And on a reverse mortgage, the unborrowed amount continues to increase over time.
Yep.
And that's exactly what this shows. It's great.
Yeah.
Nice
Yeah.
chart.
This is, this is the golden goose kind of. I don't know if that probably messed something up there, but anyhow, this is what I like to talk to clients about, because this is person with paid off home and they have 401k and they have all this stuff, all well prepared. But I have an example that if um, you don't have a long-term care policy or not really comfortable with that resource, this beats the socks off us. It does really well. Then um, let's see. Oh, this one is the retire on your own terms kind of thing. At 65, this one has a small mortgage. Okay, so this is borrowing, paying that off. So now obviously your loan balance will grow. You're not making any payments, so it would, but you also have a line of credit. So this is the hybrid. This is in between. And still, 20 years later, this client has $1 million to work with as far as any needs. And of course, you have all of this, as John was saying, all along the way. You need a new car. You need a vacation. I have one client, it was coolest thing ever. It was a manufactured home. So the dollars were all pretty conservative. And all he wanted was enough money to go visit a grandson in Germany that he'd never met, was 5 years old. And he didn't have the resources to do it. Now, that's a pretty desperate one, sort of, but it was aspirational to be able to tell him, yeah, we can do that and we can get you to go see your grandson. So pretty cool, for me to be part of that. So
And when you draw the money from the reverse mortgage, there's no tax consequence.
absolutely, it is. And you're borrowing money. You're not. And I'm supposed to say you should talk to your CPA. I am a CPA, so I meant to say that. It's not. This is a little. I did this yesterday, thinking I've got to find a way to explain this better. And because this one trips everybody up, including my ability to explain, I've tried it 3 or 4 different ways. This one I'm settled on. This is the growing line of credit trips everybody up. Well, is it earning interest? Do I have to pay tax on it? No, 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 no. It's not earning interest. It's growing available credit. So let's look at this for a second. We have a home value. That's at inception. I should probably add that at inception. At inception, you have a line of credit and a reserve, and the numbers will change a little bit based on age. So I put it right down the middle. If you do not draw on this line of credit, some of this reserve is not needed, so it starts to grow on its own this way. Okay. The other factor, and I mentioned this, was the whole pie grows. The home value grows. It's not tied to home value. It's you basically bake in 6 or 7% appreciation is what you do. The home value could actually fall and have no impact on what this does over time. So that's, I've actually had not very many, but I've had a couple of clients in areas that they're not confident of future growth in the home value and their home value. And they've actually liked this idea because it guarantees that, your total pie, so to speak, not will grow at 5 or 6%. So, and so it ends up growing, and that's how this line of credit goes from here to here to here. Hopefully that illustration isn't too bad. Stop sharing. Okay. So really, really quickly, 10 ways this strengthens retirement. And I could keep going. I could take up an hour doing this, but probably, I don't know if this is the top 10 because everybody's circumstance is different. But what we're trying to do is strengthen an already solid plan in a number of ways. Eliminating monthly mortgage payments. That could be the difference. I have clients that just give me, get rid of that payment and I'll be great. Okay, we can do that.
By the way, Clay, is that mortgage interest still deductible?
You're not making payments on a reverse mortgage, so you're not paying the mortgage interest, or excuse me, mortgage insurance. So no, that's the reason it's not deductible, because you're not making a payment against it. It's accruing. So no, you don't get
Blake, could you make a payment on it?
You can, and there are strategies, and those get real technical. But the way to do that really quickly, is you bunch it. You don't make payments for 2 or 3 years, and then you do a big payment It's converting a Roth IRA. You do all these different things that you might do that otherwise would be taxable, and you need a big deduction to offset the taxes. Then you make the payment on the reverse mortgage. Then you get to deduct the mortgage insurance and any accumulated interest. You can do it that way. That's a whole separate subject. I'm not going to get any deeper into, but it is a strategy, and something that I know how to do and will likely do myself. I don't make too big a deal about it because it's kind of it's a narrow niche, but anyhow, you could. So we're creating a growing tax-free reserve. I mentioned that. Providing liquidity during market downturns. Now, we've been up and down the last month or two, but we've had had times where the market isn't favorable, and if you're pulling out a set monthly amount out of your retirement to live on, and the market's down, well, now you have a non-taxable bucket over here you can pull it from, and you can say, oh, the market's recovered. Okay, then pay down the reverse mortgage. It gives you alternatives instead of saying, hun, we need that $10,000 and the market's off 20%. We're stuck. You don't have to do that. Strategic income planning. I briefly mentioned the Roth. There's different things you can do that you can use this as helping income planning. You can delay Social Security. You can hear arguments either way, but Social Security, if you want to, if it's beneficial for you to delay till 70, but you need some little help during the last 2 years when you're 68 to 70, you have a resource instead of having to say, no, we have to go. Replacing income after the loss of a spouse. With Social Security, you lose one of your two incomes. You might get the higher one, but still it's less, and your household doesn't change. The house still, assuming you don't move and all that. So rather than make adjustments in your living situation, you have access to a non-taxable bucket. A pretty common one, funds for in-home care and aging in place. So that is, and that some of that's temporary. You break a hip or do whatever in 5 weeks where, someone else has to take care of you, or it would be beneficial. You have that resource. One of the things we have to be really careful of is family care. A family member being the caregiver for an elderly parent or a spouse or whatever. That is a job, and I've done this several times. It's a aha moment for the kids that are taking care of the parents and I have a spouse with a disabled husband, and she's fine, right? She wants to travel, but can't. She feels she can't go anywhere because she has a disabled husband to take in as primary caregiver. Well, if you have some other resources, give yourself a 2-week break or a night break or a weekend's break and that sort of thing. You have the resources to do that. So, and the other weird, one that people always say, really, a divorce settlement. Later in life, divorces usually are actually quite amicable. It's just, we're done. And you want to get both people in a house. Reverse mortgage on the departing residence gives cash that can contribute. The math doesn't work to completely make it work, but you have to add other assets in. But anyhow, get money. Spouse does a reverse mortgage. Now you're both in a home without mortgage payments. That's pretty cool. It's nice to be able to answer the questions. So, anything come to mind, or I'll keep going? I'm going to
I'll
ask.
keep going. I think you're in your top 10.
Yeah, no, I'm done with the top 10, but I do have
top 10.
some questions seniors naturally ask. That's kind of, you have to bring these up. The balance between using your home equity now with leaving something behind is, I don't know, I could try to put these in order, but they always come up. And what I have found, and this is hundreds of these, what parents think and what their families feel are not the same. the parents think I need to take care of my kids because that's been their whole life, right? And they're your kids after all. And by the time that you're utilizing a reverse mortgage or retiring and all that, kids are basically most of the time they're set. They have their own lives, they have their own resources. They, are usually doing fine. And the ones that not, I don't know what to do, but I don't have that habit very often. I'm glad for that. Um, but what the kids say is, wait a minute, mom, dad, or it's your equity, it's your house, it's your money. Go do what you want to do and live well. They're really supportive. I I've had two situations where in what 18 years I've been doing the reverse mortgage side of it, and one situation I turned the kids into child or into elder protective whatever. I turned him in because what I thought he was trying to get his mom to do was
Elder
elder.
abuse.
Yeah, I was upset. Obviously, didn't do any transaction with him. And the other one is just sad. It's just, the the mom, two times we've been ready to go, and the two girls have a different view, and they won't sit down and talk about it, but they put enough pressure on mom that they don't move forward. And it's like, oh, I can't stand that. Let's get to the table. Let's all talk about it. And then if you decide and you learned about it, fine. But when you keep, refuse to participate in the process and then have it's just sad. And so that's two out of hundreds. Okay. So my experience is getting the family involved, or I ask the senior this, I say, who are you going to talk to when I leave? I let's include them. And let's include them in the next meeting anyhow, whether it's their family, their CPA, their financial advisor, whoever, they're good friends. Oddly enough, that happens a lot. And let's have everybody in here and let's talk about it and fire away. If it's not right, we don't want to do it. But usually, when better understanding, they're willing to do it. So, anyhow,
Well, to that point, Clay, since we are on that point, the reverse mortgage, you don't get 100% of the value of your home. I mean,
right.
on average, what do you get? About 50% of the value of your home that you can borrow?
It's probably on average closer to 40.
Okay, so there's still 60% left for your heirs if that's what you're thinking about anyway. Now, obviously, over time, that 60% could shrink, but from some of the examples you showed earlier, it may not shrink much at all. But there still could be some equity left for your heirs.
Yeah, and that's why I show this, because it is an aha moment because parents want to do that. I mean, they feel, and that's a good thing. It's a nice thing to feel. But what they don't realize is you can take out $387,000. That's a lot of money, and 20 years later, it's still leaving a lot to your kids. So that's the purpose of sharing. I do this with every transaction with a client's numbers because you want to show them. You always have to talk about the exit strategy because you don't. People stay concerned unless you can say, and this is what it looks like in the end, or at least 20 years down the road, or whatever. So that's kind of important. You're right.
Clay, I got a question for you.
Sure.
On the John and I were talking about this prior. On the say luxury homes, and this being an FHA loan, what are the height or the limit, the ceiling for these loans and loan amounts?
We'll get to that, so don't let me forget because I think I have something that'll tell you a little more about that in a second.
Okay, great, thank you.
That is a change over the last, I don't know, it's been 5 or 6 years where they've introduced we call them proprietary products, and they're designed to help where the standard home equity conversion mortgage or HECM stops. And they're awesome. Of course, we're on the West Coast, so we have a lot of properties. The limit for the FHA on the appraised value is it's $1,250,000 basically. And so we can handle properties up to $4 million. And there's some other reasons that's helpful. I'll get to in a second. So
So getting back to the heirs, uh, they have after, let's say, the parent, the surviving parent
Mhm.
passes away, uh, doesn't the heirs have 3 to 6 months to pay off that loan and keep the house, correct?
They have 2 weeks to communicate, and that's not written in, but that would be my advice, and I tell everybody. The lender knows as soon as the last borrower is paid because of Social Security, the database alerts them. They're going to start communicating because the rules from FHA say, servicer, if you don't communicate and get a plan for getting this loan paid off, we're going to hold you responsible if you don't follow these guidelines. Okay. So that sets the urgency for the servicer to communicate. It's a lot better. And I'm going through this. My stepmom had and dad had a have a reverse mortgage. And I think I was on vacation. We came back, took care of things, and I was on vacation. I was getting phone calls. So you get offended about that, but they have their job and it's a very expensive problem if they don't do their job. So my advice to clients is to have somebody in the family that knows they have a reverse mortgage and has my phone number if they're my client, or has the website and follows it. And my advice is within 2 weeks, call them and say, we don't have any idea what we're going to do. We're just kind of taking care of the arrangements and stuff, but I am the contact. I will get back to you soon. And then you got a little bit of time. So the first period, the automatic is 90 days. Communicating with them and saying, I need a little bit more time. Again, my example is my parents' home was wall to wall antiques and some deferred maintenance for a house, and it's 2 hours away. So getting that done, it's time consuming. It's been a lot. And so I've asked for an extension. So I have an extension to 6 months. So it's 190-day, and I knew I was going to blow through it. But I have the house listed with a realtor. It's not on the MLS, or it wasn't, now it is. And so I communicated. I'm going to get to if the 6 months is coming up pretty quickly. We're going to blow through that too because it's not under contract. And so again, I talked to them Monday and said, okay, we're going to need the other, but we're actively doing this and we're doing this and we're doing, and they don't have a reason to make it miserable for me, but they have to dot the I's and cross the T's. So I'll get the other extension. Now, the third extension to go out from 9 months to a year, I don't know how they're going to handle it. I'll get firsthand knowledge here, but communicating what we're doing. And at that point, we're going to have to probably drop uh, it'll sell fine. We're selling in an area that is the spring and summer it's in Monterey, California. So, that's going to do well. And we just got it, but she passed away in September and we couldn't sell it in January. So anyhow.
So
But they could just they could
the
just
extensions
pay
are in, go ahead, Alan.
they could just pay that loan off
That's
and still
that's
retain the house, right?
correct. Correct.
Yeah, okay.
Yeah.
I don't
And
want to be a landlord, but yes, if
no,
they
the
want,
extensions are in 90-day increments. Is that how it works?
yes. Yeah. And most, number one, communicate. Just communicate, and you're fine. So,
And the most that you could extend it is about a year after
yeah,
they
then,
pass?
yeah, you know what? I've never had anybody push the year. I might, I might be doing it, but I haven't had anybody do it. And because, the decisions are pretty, in fact, that was the next thing I was talking about. You can sell anytime. And the home is the only security for loans. So, the heirs usually want to, if we're not going to, nobody in the family is going to go move in to the family home, and they can do that and they can refinance whatever balance and take it over. That's fine. In
Yeah,
fact,
an interesting thing here is after you pass and the heirs are trying to figure out what to do with the home, no payments out of pocket need to be made on that mortgage. Where if you had a forward mortgage
yep.
and you're trying to figure out what to do with the home, the heirs have to make those payments to the lender to keep it going before they figure out what to do with the home. So the heirs are paying money, whether it's
Yep.
from the estate or if there's nothing in the estate, they're out of their own pockets until they can figure out what they want to do with the property.
And one thing I'll add is because the heirs are not borrowers, they don't have access if there's a credit line.
Yeah,
So
they can't borrow, right?
yeah, you got to plan, make sure you're not counting on that. Okay. So a little bit about costs. Costs for the standard are 2% of the max claim amount for the mortgage insurance up front. That's the expensive part of a reverse mortgage, a standard one. And I usually explain that. I say, okay, if your appreciation is 4%, 2% is not a big cost to give up 6 months of appreciation to get this. It is a number, it protects everybody, protects the lender. They're going to get their whatever they lent you back plus interest. That's all they get. But they are guaranteed to get that. That's why the mortgage insurance fund sits there. As a borrower, you get the benefit of no risk for the investor, so rates are lower. And you'll kind of see that when we go to the proprietary that doesn't have the mortgage insurance, which sounds okay, good, but they have higher rates. And the difference is, 2% or maybe even 3% difference in the interest rate. So it's just a matter of transferring risk. And up front with the costs, it's normal title and escrow, and um, uh, as far as the upfront cost and that sort of thing, there's never anything out of pocket. It's just added as the first draw on the loan. So, um, and
Those expensive title expenses are added to the first payment
the
of
first draw, think of
the
it.
first draw. Okay, it's part of that first draw. Okay.
And we've covered this. What happens when you die? Home is the security for the loan. So if it's underwater, you turn the keys over. And but the home is sold generally, balance paid back, remainder goes to the estate. The family can purchase home if they'd like, just refinance. Done that a couple times. So
Is the sale of the home done through a regular real estate company, or is it done
your
through
choice.
It's not court.
Absolutely.
It's not a courthouse step auction thing. Okay.
No, no, it's and just for fun, this is that's right, I went back. This is a real client. It's actually her picture. Um, and this is a client. Now I should update this. We're 2.5 years into it, but it's probably close to 3.5 years. This is where he started. This is from a financial planner. Investments, really pretty good shape. Paid off home, getting Social Security, whatever. She's doing great. But what we were able to do is she was stressed about long-term care. She lived on her own. That shouldn't be a factor, but it is. And said, all right, this is kind of the similar numbers we talked about earlier. She got the line of credit. And this is again a little dated, 2.5 years. But when she's 85 or 90, she's going to have these kinds of numbers. $600,000, $700,000 of resource to pay for any care that she might need. And this is just awesome. She had a stress.
You have to scroll back up because we're only seeing, we missed that part of the chart, Clay. Just scroll back up a little bit.
Well, what do you mean, this one?
It's
all we see is gain flexibility and confidence.
Oh, I shared the wrong thing. Hold on. It looked great on my side. I don't know what's better with you guys. There we go. Is that better? You have a.
Let's see here.
There we go.
Okay. Yeah. Okay. Now you can. Now, if you want to scroll down, and we can see the numbers.
Yeah, and then and
there we go.
And this is her line of credit again after when she's 80 and 90, 85 and 90. This is a real.
Oh, wow.
This is and I talk to her every 6 months or every year, and she's you tell anybody that he wants to do this, you call me. I'll tell him what the real story is, and she loves it. So, and she doesn't use it, so that's a good example. So, okay, how are we doing time wise?
We're fine.
I gotta hurry. Well, because I want to get to the reverse mortgage for purchase, which is my favorite part of this. So, we seniors have $14 trillion in housing wealth. We mentioned about the sellers and buyers being really active. And the most fun of this is it's a pretty, well, if somebody's going to buy a house we want to help them. And so $750,000, this is a very typical thing. Sell the family home, pay off the mortgage that they use in their second mortgage or second mortgage they use to put the kids through school, whatever, they have debt, they're carrying debt, and say, listen, we're going to cash out. They're going to get $750,000. And the mindset is, I'm going to go find a house for $750,000, whether it's in Iowa or wherever, because I don't want a mortgage payment. And yet we can talk through that and do the same thing, same loan, just a different application that they can buy. I got to the second choice first. The first choice is buy that $750,000 house, but add $235,000 to investment. That's the part of it that's the reverse mortgage for purchase. So they got the same house, but yet their portfolio or investments are up by $235,000.
H4P means home for purchase, correct?
HECM, home equity conversion mortgage for purchase. That's why we call it H4P.
Okay.
Then with this is the upgrade that I like a lot, because they're making decisions. Oh, I really like this house, but I really want to be here, but, and in this case, okay, use your $750 cash, buy the $950 house or more, and still put some money in investments. And so they can buy a bigger house or better house, better located, whatever that might be, they can do it. And this is a client I did not, well, it has been a year and a half or 2 years. She had $4,300 in housing cost. And that because she had a first and a second and other expenses, I guess. Stick with that. Mostly dealing with the 2 mortgages she had. So we sold her house, that's down here, and she netted $648. Bought a house about 30 miles away in a retirement community for $716,000. Even though she got $648, all she needed to get this house was the $450. So she didn't have a lot of reserves. So she put $200,000 in reserves, got the house she wanted, and her housing cost went from $4,300 to $644. Amazing transition for her, and something she didn't believe she could do, all up until literally signing her loan docs. She didn't believe it.
And her brokerage account doubled, it looked like.
Yeah.
Yeah.
So
and I was born in Concord.
there you go. Well, then you know this. She moved out to Brentwood. Brentwood is where everybody goes to,
Right.
Yeah. So really cool. I mean, this kind of client's a lot of fun because I was serious from day one. This is impossible. This is impossible. You really think it would call me more times than she should to make sure things are working well, and we got it done. So it's a lot of fun. HECM for purchase, no different than the regular loan, except this. You have to create equity. So it's a substantial down payment. The $450,000 in her example on a $700 some odd thousand home is substantial, 60% or so. You have to do that, but really cool to be part of. But this is a list of what has to be done. We've kind of talked through the benefits. I like the benefit to realtors, and I'm communicating with a lot of them now and saying, look at this. You can go and help somebody that's hesitant to sell because they don't know where they're going. Show them how they can go to the place they want to go, and they'll love you and they'll list with you. And I don't have direct contact with all that many people selling, but when I do, this is exactly what I tell them. And they go, a light bulb goes off and says, well, this sounds like no brainer to do. Yeah.
Gee, Clay, that's a great idea. We may want to do a separate, smaller podcast, reverse mortgages for real estate agents.
I'm all over that. In fact, anyhow. So we talked about financial assessment. We talked about qualifying. Same thing. There's no difference here. And One thought I had is what makes a good candidate for a reverse mortgage or to consider have it. I don't even want to say do it. Having the conversation is sufficient for me because then one more person is educated on how it works, what it can do. And I'm always successful getting them moving from no way over here to, well, maybe that's success because then the next person they talk to says, well, this Clay guy seems to know a bit about this. And it has resulted in a lot of business because the education side of it is really the way to do it. So the good candidate is somebody that's taken the time to understand the strategy and focused on outcomes rather, cash flow, flexibility, lifestyle, rather than the troublesome candidate that's going to look at that statement every month and see the balance go up and with their original mindset say, this is terrible. I'm stressing out. You don't want those, if you can't think about it in a productive way, then you're going to stress. All right. I don't know how many, I only have a couple more of these. This is the process, the learning, exploring, talking about it. This takes the longest. And some can be 18 months or a year. I don't care. Again, these are enjoyable conversations. They're somewhat repetitive sometimes. Fine. I don't care.
Actually, the first step to this point is they actually have to attend a counseling session and get a certificate saying that they passed.
Yeah. Yeah.
So-
Once you get, yeah. And that's more, it's routine because I always say if you learn something in the counseling I didn't tell you, then I didn't do what I was supposed to do. So, but it does give you a third, the senior, the client, another voice to talk to make sure. There's a lot of people that'll push in this industry, and I think it's terrible. It's a bad idea. Then when you get down to doing something, past counseling, you have to get a certificate. California, you have to wait 7 days after that. And then it's fairly, pretty routine or familiar process that we might see going forward. So then let's see. Okay, this now the fun begins. This is, we mentioned marketing to seniors, or excuse me, to realtors. This is a flyer I prepared for John's next house. Okay. John, I asked him for a house that he'd look at and say, ooh, maybe I could do that. And it's a house in Scottsdale, $1,750,000 house. And I don't know what John's age is, but let's assume it's 62. The check that John would write to get this $1,700,000 house, including closing costs, would be $1,098,000. $1,198,000. No, $1,098,000. I had it right first time. And could live there for as long as he is a primary residence in his home. If he's older, that number goes down, and this shows you kind of the relationship between purchase price and what is possible. And this is the proprietary one. So this is a jumbo one. And to be, this is the kind of stuff I talk through, and more pictures of John's house, by the way. And it's a fabulous house. I mean, I don't know if I could deal with the heat living in Arizona, but this would be a place where you would.
Certainly looks turnkey.
Yeah, no kidding. And down to the furniture, man. But look at this. Living in that house for 20 years. Now, I mentioned the rate is higher on the jumbo stuff or the proprietary stuff, and there's no mortgage insurance up front, or ongoing. But for $1 million, $1,100,000, John could live in that house for 20 years or more without a mortgage payment. This is the cost.
And even more, because even if you goes upside down, you can still live there. It doesn't matter.
Correct. Yeah. So I think I calculated it's an average of $4,500 or something like that. Well, for this kind of house, $4,500 would be cheap, relatively cheap. That's what you're giving up is your original investment. So very plausible, very cool. And John, if you need somebody to do the loan, I'd be happy to help.
I'll invite you to the housewarming.
There you go. There you go. So a little more about proprietary options. This extends what we've been talking about to younger clients as young as 55. It'll handle higher value homes up to 4 million. More complex planning scenarios. So there's things that get a little complex to talk about, but you have more flexibility. They don't have the FHA 8 HECM rules. And also properties that don't fit standard HECM guidelines, the most prevalent of which is the condos. And I have one now that we're able to do a condo that is not FHA approved, so couldn't do the standard, but we're gonna do the purchase with a proprietary, and it works out
Interesting.
better anyhow. You have more flexibility than you have in that part of it. So lower upfront cost, higher interest rates, no mortgage insurance. So at the end of the day, it's about understanding what's possible and just being educated. And you don't get any pushy from me at all. And most people have never even seen these options. It's not something they've been exposed to, and it's just sad. I mean, it's sad in a way. I feel responsible to fix that, and I think realtors and financial planners and mortgage professionals should feel a responsibility to share this with clients, because if they're not, and they just push them into whatever they want to do for realtors, financial planners, and mortgage, because that's what they're familiar with, I don't think they're serving the client the way they should. And I can do regular mortgages and all that, so I don't push them this way either. Just say, hey, these are the 3 or 4 things that could work for you. And it's a great conversation. They're really rewarding relationships I've had with the clients that I've worked with on this. So,
Well, that was excellent. Excellent information, Clay. Excellent presentation. And I know even with all that and spending an hour on this, we've really just touched the surface of a lot of this stuff. I mean, you get into it even more. Anybody want to add anything here on the panel to some of the things that Clay said, or some of the other things that reverse mortgages could relate to?
Clay, you explained it really well.
well, thank you.
Yeah.
We ought to talk more, because you're with being involved in the probate and realtor and all that sort of stuff. I mean, it's a related discipline, and it'd be good for me to learn a little more about that too.
Very much so.
Yeah.
Well, that'd be great. That'd be great. Well, I hope you all learned something. This was great. This was a great information. But like we said, we've kind of scratched the surface. We can get into more into this, like how can you qualify? How is income calculated? How is, what we did go over how much you can borrow, and if you're older, you can borrow more. There are second mortgages on this, as Clay mentioned too. So you can have a first mortgage, forward mortgage that you're making payments, and get a reverse mortgage second, and you may be able to borrow more than you could with a regular reverse. But these are all sorts of topics. Today was just to introduce you. If you have questions, give any of us a call here on the panel. We'll be happy to help you. And other than that, anybody else have any other parting words?
I like the examples that Clay had showing the actual numbers. That makes it much easier for people to understand how it works.
Yeah, just telling them conceptually, it's too foreign to really understand. And honestly, I started on this 18, 19 years ago. So, and at first it was like, what in the world are you trying to tell me? So.
That's great. Okay, well, thank you all. Thanks for watching, and we will see you at the next podcast. Thank you so much.
Thank you.
Thanks so much. Thanks.
Thank you.
Appreciate the opportunity.
Sure, thank you.